Blake Boss here, folks. Today we're going to be looking at DryShips earnings. We're going to be slicing and dicing them. First, let's look at Wall Street wanted. Well, they reported earnings and they basically met or exceeded analyst estimates. But as investors, we always want to focus on the underlying business. And with DryShips, we need to look at their liquidity. Liquidity remains the theme here. Remember, they can't use any of Ocean Rig's operations to use for their dry bulk or tanker operations of the company. They have a huge stake in that company, but they can't use those assets for their means in their dry bulk shipping or tanker. So the company has been working with lenders to restructure some debt agreements related to that tanker and dry bulk segment. Loan covenants have been breached on those loans, and they had to reclassify $1.1 billion in debt to current liabilities. And technically, that debt is subject to call for repayment from lenders if they wanted to. So some very bad news here if you're invested in DryShips or thinking about it. So this becomes especially worrisome after you look at the cash flow the company has been producing over the last 6 months. They produced $4.3 million from operations. They used $252 million in investing activities and produced $131 million in financing. What that amounts to is a negative $116 million in cash used over the past 6 months. You combine that with the factoid that they have $1.5 billion in current liabilities due within 1 year, and you better have your life jacket handy, folks. And to put this in perspective, this picture right here is what I would consider a healthy shipper. It's a nice looking ship. And if you look at DryShips, this picture right here kind of sums it up. This isn't DryShips ship, obviously, but this is how the company is looking right now. It's not looking good. And also on top of all this, you have some kind of worrisome details in the related party transactions at the company. You have the CEO separately owned finance firm Vivid providing financial advisory services to both Ocean Rig and DryShips. So basically the CEO gets paid through his other company from providing services to the company he sits on as CEO. It's a worrisome related party transaction. And also the company previously leased office space from the CEO's son. So basically you have the company shareholders paying for a lot of things that the CEO benefits from. That's not something you like to see when investing. So if you want to invest in dry bulk shipping, this is not the way to do it, folks. We've already seen them pledge Ocean Rig shares as collateral to debt. So investing on the basis of getting a stake in Ocean Rig is not a foolproof thesis. If you must try and call a bottom in shipping, make sure they're built to last. And what I mean by that, check out the solvency ratios. Make sure these companies can last a prolonged downturn if you're trying to pick a bottom in this industry, but it is especially dangerous. That's all I had to say about DryShips today, folks. Thanks for watching, and Fool on.